Good morning, everybody. Welcome to the Institutional Investor Panel. Please come into the room and scoot forward to make it a little cozy. I would encourage the money managers and the private equity and real estate and alternative investment people to text your friends and tell them to come in here, because there's about $1.5 trillion of investment judgment sitting up here in front of you. So we're here to help you understand our world as institutional investors, as well as give you our advice on how we're managing our portfolios. And I think individually you can take that in turn also, not only how to manage your firm's money, but how to manage your own 401k. My name is Christopher Ellman. I'm the Chief Investment Officer for the California Teachers Retirement Fund, CalSTRS. I want to say welcome to California and thank you for coming to the Milken Conference. This is a very impressive panel, and I'm going to try and be quiet and just let them do a lot of the talking. But let me introduce them first. Michael Sabian, who is with Case Depot up in Canada. Jane Modello from Harvard Investment Management Company. K-Ping Li from China Investment Company, who I think a lot of people have heard of and know a little bit about, but not much. Sisma Hingarani from the Office, I want to get it right, the Bureau of Asset Management, but the City of New York pension plans. And that's a very unique system with 5 different pension plans and boards, and so we're looking forward to that. And Jerry Albright with the Texas Teachers Retirement Fund. So teachers are represented well here today. So I've got questions for each of the panelists. I'm going to let them talk a little bit about their perspective, but as I have done earlier, I'm really going to encourage you to each talk amongst yourselves. So my first question is really to present your perspective on your fund, because we all have very different liabilities and very different cash flows. And that really is the first thing that tends to drive our investment perspective. So Jane, can you talk a little bit from the Harvard perspective as an endowment? What's your cash flow? What are your liabilities? How does that interact with your decisions?
Sure, thanks. So I typically think of Harvard as the big gorilla in the room in terms of size, because we have a $33 billion endowment, and that's the biggest college endowment in the world. But in this panel, I think we're more like the big chimpanzee, not the big gorilla. My fellow panelists have probably 10 times on average the amount of assets that we have. We do have some advantages in being large in the endowment world. We're able to invest about half of our assets through internal trading teams that work directly for us at Harvard Management, which gives us transparency and nimbleness, which a large fund might not otherwise have if using all external managers. And we've also been able to, on the alternative side, enter into direct investing, which we'll probably talk a little bit more about later. But direct investing requires a certain bulk of capital, the ability to build a specialized team, and to layer in the expertise both at home and locally to manage assets well. So size has been our friend. We do provide 35% of the operating budget of the university, and that creates a certain amount of pressure.
35% of the annual budget.
35% of the annual budget. And a significant payout from our portfolio. So as much as we are primarily and significantly long-term investors, and that gives us a lot of advantages, we have to think carefully about the balance of liquidity and illiquidity in our portfolio in order to meet those needs of the university.
Now, how much of the assets do you manage internally, and then how big's the staff?
We manage about 30% of the assets internally, probably 60% of the publicly traded assets internally. The staff overall at Harvard Management is over 200 people. We have about 35 investors on the public side and about 35 investors on the alternative asset side. And doing the type of trading that we do on the public market side requires a lot of IT and operational and accounting backup, so a lot of the rest of the people are there.
Okay. Sisma, talk about a little bit about the New York City funds, because it's a very unique structure. Your office is unique, and give people that perspective.
Sure. So in New York City, we manage about $150 billion in total assets. And like Chris mentioned earlier, we have a unique structure. It's spread across 5 retirement systems. So we have 5 boards. We have 58 trustees. We have 5 general consultants, all of whom are different for each of the boards. We have 2 private equity consultants, we have 2 real estate consultants, and we have a hedge fund consultant. That's our governance structure. And
that's a lot of cooks in the kitchen.
Yes, so it creates, added complexity, more challenges. All of our money is run externally, so we have no internal management. And if you look at the top 10 public plans in the country, of which we're number 5, the average is 50% managed internally. So we have 0. So we have some work to do there, which we are focused on. In terms of a funded ratio, so as of our 2013 Comprehensive Annual Financial Report, which I'm sure many of you read, the funded ratio is about 61%. That's a 2011 number. So at this point, we would think it's a little better than that, but still, nonetheless, it's a low number, so we have a lot of work to do. Now, our actuarial rate is 7%, which is down from 8% as of a couple of years ago. So it's better than 8, 7, but we still have a long way to go. In terms of benefits and withdrawals, so we pay out $12 billion a year for benefits and withdrawals, and this is across over 700,000 beneficiaries, existing and active and retired. The city contributes about $10 billion a year. So while this funding gap has narrowed over the last 10 years, there's still more money going out than coming in by about $2 billion. So it's clearly a drag on our performance. So getting to the 7%, as I know we're going to talk a lot about, how do you do that in this environment? It's a big deal. And we've actually done a little bit of math where we looked at over the next 20 years, and if we're able to hit a 7% return every year for the next 20 years, and the city of New York continues to contribute $10 billion a year, which we're really hoping they can do, and we can do, we would meet our obligations. So that's good, but hitting 7% every year for the next 20 years is not easy. So that's how we're set up.
An interesting challenge. Kei-Ping, I think the audience is very interested in CIC. Even my wife asked me when I was coming down here to say, learn more about China Investment Company. They're fascinating. So please, share some information.
Okay. First, CIC is a sovereign wealth fund established by central government, China government, at 2007. So therefore, we are a relatively younger institution compared with other institution investor. Second, right now, we manage total asset, roughly, more than $600 billion US. But that is separated 2 parts. One part is more focused on domestic market. It's a shareholding company, more focused on financial institution. That is more than $400 billion total asset. So today, I will talk about another part. CIC International. CIC International is very focused on global investment, or only overseas market. We can invest in the market. So CIC, as sovereign wealth fund, our mission, our target is protect and increase the value of the fund. This is like a reserve fund. This is a generation transfer, a wealth generation transfer. So that compared with other institutional investors, we don't have clear liability. But one thing is clear, we have relatively longer liability because we don't have cash flow demand in short term. We have less liquidity constraint. Therefore, theoretically, we can very focus on long-term investment target. That's a lucky part. And for long-term target, we have relatively higher proportion allocated in long-term investment. So roughly 50%, according to our strategic asset allocation, we allocate in long-term asset. So in our case, that means private equity, real estate, infrastructure, agriculture, and relatively concentrated private deal in listed company. That is roughly 50%. But because this is a young organization, so far we're not fully invested in long-term asset allocation. This is this is not fully invested part, it's a proxy portfolio. This is a public market, equity and fixed income. So another part for public market include the equity, fixed income, absolute return. In this case, CIC is a very diversified portfolio. And the relative is equity dominant. We have relatively larger equity or private equity exposure in our allocation. So this is a framework, but maybe a few words about external and internal. So roughly we have 60% to 70% asset managed by external, but we don't have fixed proportion about that because this is more depends on ability of our internal team. So this is something?
Yep,
okay.
No, that's very helpful. That's a great overview. I want to get into, we all have long-term liabilities, but we do have some short-term demands. How do we balance that long-term investing goal with the short-term cash flow needs and the pressure on annual performance? First, I want to turn to Jerry Albright at Texas Teachers.
All right, Chris. Give you a basis for Texas Teachers. It's a $126 billion pension fund that serves 1.3 million members in Texas and their families. We touch 1 in every 3 Texan at Texas Teachers. We have a negative cash flow of about $3 billion a year, so not bad. We're satisfied with that. Our actuarial rate is 8%, so you said 7 was good, 8 was bad, I don't know. 8 seems to be good. We feel like we can, in a long-term basis, manage to that 8%. I think that our strategic asset allocation results proves that out, that we can probably get 7.4 going forward on a long-term basis, and that's what we think about, very long-term. Our liability stream is super long-term, 24, 25 years, way out there. And so the ability to earn 8% over long periods of time, historically, we've been able to do that. Our own experience shows that it is possible. And today, we're investing money for people that are joining the system today. You know, our kids that are now teachers in school, their first and second year teaching, we're investing their money now for their long-term retirement some 25, 30 years down the road. So it's us long-term is just way out there. The pressure to make 8% seems to be a reasonable goal, 7.4 from the market, and we believe we can add 100 basis points ourselves doing various things inside the investment division. We're about 60% internally managed, the rest externally managed by some of our partners out there. Our public markets is about 25% externally managed, but most of that is internal, and we have an excellent staff that manages that money internally of about 141 people. So a well-resourced system. So that's our broadest view on a long-term basis, you know, make 8% over time. Short term, yeah, the pressure's on for all of us. Short term, many people look at us in different lenses. We look at ourselves as a very long-term investor, but our actual rate, 8%, smoothed over 5 years. So there's a 5-year mark that somebody's marching to that, you know, we've got to also take into consideration. And our investment team has performance pay based on primarily a 3-year return. Secondarily a 1-year return. So there's also pressure at 1 year, there's pressure at 3 years, there's pressure at 5 years, there's pressure at 20 years. So there's pressures all across the boards. So what do we do about that short-term pressure? Long-term, you know, we think we can satisfy that. Short-term, I think there's a lot of intermediate things that we feel we can do, and that's use our strengths. Texas Teachers is large, it's unlevered, it's liquid, and it's very long-term. And those are strengths that we have. We're also very innovative in our culture as well. So liquidity, you know, massive amounts of liquidity. So what can we do in the short term? We can bring that in a little bit, do a little more in the illiquid asset class to bring up returns. Unlevered now, you know, maybe we can increase leverage through a variety of options, some traditional leverage, some risk parity maybe, to increase some returns there. So that's liquid, long term. unlevered, innovative. We've created a culture of innovation where, you know, we ask our external managers to bring innovative ideas to us. We have an internal innovation team that innovates products internally as well. And we have a testing platform to test out those innovations, to juice our returns there as well. So we're doing a lot of things intermediate to try to get that return spectrum up and ease some of the pressure short term. But you know, a lot of the short-term pressure in a long-term fund like ours really gets back to communication, right? It's education and communication. We communicate with our members. We have stakeholders of members. We have stakeholders, employers. We have stakeholders of the legislature and the great state of Texas taxpayers. All of these are pressures on us in communicating with them about what our long-term goals are and what the volatility in the market's going to look like, and how we get through that using our long-term vision is very important to us. So.
Yeah, I think the contrast between short-term and trying to be a long-term investor is a struggle for us. It's a struggle. A lot of the panels, even in this room over the last 2 days, have talked about that. We talked about it as it faces CEOs. Even last night we talked about it when it comes to things like water, making short-term decisions that in the long term aren't effective. It's very hard to keep that long-term perspective. Michael, can you tell us a little about Case Depot and then how you deal with the short-term, long-term balance?
Well, we manage about $200 billion of assets on behalf of 8 million Quebecers. That covers both pension assets and social insurance assets. We manage those about, depending upon whether you call a co-investment something that's internally managed or not, we manage somewhere between 85 and 90% of our assets internally. And our target on average, because we manage on behalf of about 30 different organizations, on average it's about 6.5% a year that we're trying to earn. We're still in a net inflow position from the organizations whose assets we manage. We have the luxury of actually managing assets and not having to manage their liabilities. They manage their liabilities, and we just need to back the truck up and unload 6.5% on average over the long term to them each year. So our focus is, you know, to be honest, we don't, I mean, this may sound overly simple, but we don't really focus very much on short-term issues. In fact, over the last 3 or 4 years, one of the things that we've tried to do is to create an organization that is actually very consciously not focused on the short term. And we're doing that for a variety of reasons. Some of them, which perhaps we can come back and talk about, some of them have to do with a concern that we and a number of other funds, our friends at the Canada Pension Plan, other funds across the world who we're now working with more collaboratively on this, are concerned about the extent of the short-term pressures in the market. And I think we have a responsibility as a manager of public assets to put more emphasis on the long term, given the kind of short-term pressure that so many corporates are under. But we can come back and talk about that. But overall, our focus is very much that being a long-term investor is a source of competitive advantage. And that a long-term investor can do things and can open market opportunities that investors more focused on the short term. And I'm not suggesting that I think short-term versus long-term is bad and good, you know, black and white. Clients have different needs. In our case, they're long-term oriented, and that gives us the opportunity to be a very long-term oriented investor. That being said, it does open opportunities, as I say, for us to do things and to invest in areas where there aren't as many people, and where we can do things which, as I say, therefore are a source of competitive advantage. Now, in how we go about it, you know, I think that there are really 3 things here that are important. To be a long-term investor, obviously that touches the core of what your investment strategy is. And I think sometimes in discussions that I'm part of, sometimes people run together an increase in the size of your alternative asset class with the degree to which you are a long-term investor. And that long-term, short-term issue becomes an asset allocation or an asset mix issue. I'm not really sure that's true. I mean, that's part of the story, but I think being a long-term investor actually influences how you think about every asset class you're in and how you manage every asset class. So public equities, for instance, we've recently changed quite substantially our public equity investment strategy so that now what we used to do, which I think a lot of people have done, is our investors would take a benchmark, whether it's the S&P or the TSX in Canada, and use that as a starting point for building a portfolio. I mean, personally, I don't think that's a good starting point. That's a good way to judge your performance after 4 or 5 years, perhaps, but it's not a guide to how you should invest. So we've scrapped that, and instead we're just building equity portfolios. And today, I think of the 70 billion we have invested in public equities, we're getting to about 50 billion invested in pure absolute return. I don't care what the benchmark is. I don't care what the weight in the index is. If I like the stock, we buy. Not I personally, our people who actually know what they're doing. But if our teams like a particular stock, they buy that stock. If they don't like another stock, they don't buy it, whether it's in an index or not. So it's purely absolute return focused. We buy large companies, high quality companies, pretty stable businesses, and we're prepared to take large concentrated positions, which is a significant change from what we used to do. Another part of how you invest that goes with what I just said about public equities and also with alternatives, and something that we are now putting an awful lot of emphasis on, and that is research and depth of research. And we've built pretty substantial research teams. And in fact, again, this may sound a little nuts, but not research teams who are focused exclusively on financial analysis of a company or an infrastructure project or a real estate project, but rather research teams that understand the operations of those businesses. So we've hired a lot of mining engineers, people with experience in consumer products, people with experience in transportation, pipelines, airports, railroads, but people who understand operations as a source of value creation. Because in the long term, our perspective is that operations is the source of value and financial engineering is not. So that's involved a substantial amount of change in our organization, and we're doing things a lot differently than we used to over the last 4 or 5 years. I think I'll stop there because I'm taking too much time. There are lots of other things I could talk about what you need to do to put a program like that in place, because it's a big cultural change inside an organization like ours. But to summarize, we're very focused on longer-term returns, and we're not preoccupied with short-term objectives and kind of short-term noise that's all over the market.
Thank you. You raised a couple of very interesting points, the active-passive, which I'm sure we could debate at length, because some of us have very big passive portfolios, some would like to be very active. But there's an interesting theme running of private assets and whether we're doing that internal or direct. So let's jump over and talk a little bit about that. Jane, you have a famous team, and you're very active in that area, but you're not doing direct investments in all asset classes. Can you talk about that?
Yes, sure. Actually, I just want to jump in on the long-term too for a moment, because it's very much related. We work for an institution that's been around for 400 years and likely to be around for at least another 400 years. That's a long-term perspective, at least in American terms. And there might be a few Europeans out here who think that's short time, but it is a long time to us. That means that we're enabled to think about things in a very different way. We just closed on an investment this month that has a 50-year time horizon. Obviously, this investment's going to outlast me and my team in our jobs. So there's a special era of responsibility around making investments of those type and that longevity, and specialization that's required. You may have been referring in direct investing to our natural resources team. We were early movers into natural resources. We have a very specialized team, deep team of people at HMC, and then an extensive team of local partners who help to manage our properties. Over the last 10 years, we've planted 100 million trees in a variety of countries around the world. And so, of course, that requires a web of specialized management. It also requires an extensively long-term horizon. We're growing trees literally from the roots up, as opposed to buying mature assets that might be able to be harvested closer to near term. And by doing that, achieving returns and pricing that is much more attractive. But there's so much that goes along with that in terms of the layers of expertise that are required, the far view that's required, and the sustainability challenges that go along with that, which is a big part of what we think about and what we do. And I know there have been other topics at this conference on sustainability, but that 100 million trees that we've planted is estimated to be capable of sequestering 2.5 million metric tons of CO2 per year. So as well as being very attractive investments, there are some other environmental and sustainability attractive features of this type of investing that we feel very proud of. But the direct investing program in natural resources at Harvard is really one of our key competitive advantages. We've followed that program with a direct investing program in real estate over the last 3 or 4 years, in which the early results are very promising. We had found that being a limited partner in real estate funds hadn't really met our objectives in returns from real estate. There may be a number of reasons for that. There may have been a mismatch between our time frame and the time frame of the funds that we were in. There may be a need to be more opportunistic in real estate than what we were able to achieve by using exclusively outside managers. But we've done a similar thing in real estate to what we did in natural resources. Hired a team with leadership with deep experience, built out that team, and added layers of expertise at the local level so that we can execute and enter and exit at, we think, are very attractive terms.
So 50 years is a very long perspective, but Kei-Ping, you mentioned intergenerational,
yeah,
which is 100 years, 60 to 100-year perspective.
Yeah, maybe 20 years, so it's a generation.
Okay, yeah. Hopefully, you're right, generations are turnover quicker, but you have a desire to grow your private part of the portfolio. Are you going to do that direct through partnerships?
Yes. Like I just mentioned, now first we have relatively higher proportion allocated in long-term investment. So that means we have relatively larger part allocated in private. I like to say the include is a private equity, typical private equity, and also include other like infrastructure in real estate. Our equity is very focused on equity, but also include private debt. So in our case, we have now first is in some sector, we relatively very focused on set up internal ability. And generally speaking, we have relatively more is external. So that means the private equity fund set up our network, cover global different region and the sector. And the second is a co-investment with GP, because you can have more opportunity to use their professional ability, help us work together. Third way is a direct investment. But I think this is a two factor are very important for us in our practice. Number one is internal ability. This is more dependent on our staff. And second, partner. Because we are financial investor, we don't have any ability to running company or project. We have to looking for other partner. It's an international partner, local partner, work together, and who can help us to running or manage. So we can help each other. So this is something like a win-win strategy. This is so partially external, partially internal, direct investment.
Thank you. So the co-investment or the strategic alliance opportunity, all of us, I always say Goldman Sachs would love for us to compete on deals, because then we're driving the price up and they make money. But there are opportunities to work cooperatively together, to syndicate transactions or invest together. Fusma, at New York City, you've got those different boards. How much of your fund, like particularly in alternative investments, do you do through partnerships? Are you able to do any co-investments? Are you able to do direct transactions?
Yes, so sitting up on this panel, I feel like New York City, we're making our way, but we're clearly not as advanced. We'd like to be more like the Canadians. We'd like to be more like the Harvard Endowment. We certainly have a long-term time horizon. But when you think about it, before 2010, the majority of our assets were invested in public markets. Actually, going back to 2006, we only had about 10 or 11% in alternatives. We're now moving that up with a new asset allocation policy, which New York City had not done in 5 or 6 years before 2010, to the point where by the time 2016 comes around, we'll be closer to 25% of our assets in alternatives. You know, our trailing 10-year return before 2010 was 3%. And 4 years later, it's now close to 7.5%. So we are, you know, hitting our targets, but we need to do a lot to diversify our portfolio. Again, still 60% of our assets are in public equities. We have a lot of public equity volatility, so we've been trying to diversify our asset base into hedge funds. For the very first time, New York City invested in hedge funds, and our very first investment was made in 2011. Now we have $3 billion invested in hedge funds out of a total $4.5 billion allocation. Private equity, we increased our allocation there, where now we have total commitments plus market value, $17 billion of exposure, where we are doing many more co-investments. We're very interested in doing that. We have the money to do it. We have the scale to do it. And we keep trying to hire more expertise in-house to help us achieve that. Also in real estate, we're also doing more co-investments. We're actually doing even more separate accounts, joint ventures, partnerships that we really are trying to think about because, you know, we go to one of our board meetings, which is the teachers' board meeting, and they're based downtown in Manhattan, and they're in this really nice building on 55 Water Street. And you walk into the building to go to the meeting, and right there on the inside when you come in says, owned by the state of Alabama. Why don't we own that building? So we really want to start taking active ownership, and it would require hiring a team that has expertise, as Jane mentioned, to do direct real estate investments. We should be doing that. We're New York City. And so we are taking a much more active approach there. Now we have this one possible constraint, which is called the New York State Basket Clause. So for those of you don't know too much about the laws. I've learned a lot about the laws in New York City since taking this job. But it's a law which says that New York City, not only New York City, but New York State Common, which is the large state plan, and then New York State teachers, we cannot have more than 25% of our portfolio in alternatives, non-traditional assets, so not just alternatives. In fact, it includes any international equities above 10% goes into the basket. So it's many years old now, but we have this in place, and so we are working hard on trying to increase that limit because many of our retirement systems are already bumping up against that. So it's very important for us to continue to diversify the portfolio, and we are trying to take more active stakes. Now, for us to go direct, it will take us a while. We need to hire a lot of talent who has that kind of expertise. And you know, another one of our constraints is compensation for our staff, which I've talked a lot about before, and it's one of my big issues to try to address, where our staff is paid well below median when you look at the top public plans in the country. And you know, so it's a matter of retaining talent, and it's also a matter of hiring new talent. And we are in New York City, which is the financial capital of the world, we think. And we have all this great talent out there, but it's very hard to attract them. So, but it is the goal, it is the idea, it is the plan.
Yeah, I think you'll hear from this panel, one of the key differences, not only just from our institutions, but is our governance models. The public pension plans, we're really operating out of a governance model that was designed in the 1970s, and I think has not been modernized very much at all. The endowment world figured that out and moved outside and became investment management companies. You're only 30 years old, so you get to start with a blank slate and build out. And then obviously almost all of the public plans envy the Canadian model with crown corporations where they have fully become investment management companies. And that really drives your ability to do directs and to do a lot of private. Jerry, why don't you talk about, you know, Texas, you've moved out to more of a bit independent model, but.
Yeah, we have, you know, from a traditional pension plans, you know, 7 years ago to a more of an endowment model like Jane now with our asset allocation and our internal capabilities, you know, much more mature than they were 2007. Nothing like Canada where sounds like he's got an open checkbook and get all the resources in the world.
Not exactly. Not exactly.
But I think at Texas and any public fund, Chris, we're resource constrained in our world. We're public servants and as you, and so it is hard to make yourself competitive in pay. You have to have a board that's very dedicated to that. And fortunately for us, we do have a board that's very dedicated to having appropriate compensation at the pension fund, and we've been very rewarded by that by hiring some excellent talent, and I think that says a lot about our structure. And just the competitive nature of the business that we're all in, right? It's just hard to capture these people. Now, we're in Austin, Texas, the best city in the world to live in right now, if you read most magazines and articles. So Austin's a great place to attract and actually retain people. But at what cost will they stay there? And it's a cost to them to stay there. And I talk to a lot of people coming from the outside. It's actually an increase from them to come to Texas, because of our tax situation, and our cost of living is basically cheaper than New York and California. So it's a great place to attract and retain people. So as we move closer to this private markets endowment model, I think we'll continue that process, and we'll be more aggressive, and we'll be more like them. Will we ever get all the way there? I don't know, but we're getting awfully close. Jane should hear the horse hooves getting closer all the time to their model, because really it's the market that's driving us all there, right? I mean, we used to sit back and you could have your fixed income portfolio and you could make your 8% return, and it was all nice and good. And now that's kind of going away, and now we have to make it on our own. And so the only way we can do that is to go to these endowment models. And I think that's where a lot of the public funds are, chasing that model.
Chris, can I just comment on
Definitely.
On this issue about direct? And I agree, there's issues of scale and compensation and building a very talented team that has to be world-class, all those things. But I just want to pick up on a couple of things. One thing that Kipeng said, which I think is really important, in our language, you can't do, we certainly don't feel that we can do direct investing without having created, what we call a knowledge network. And a knowledge network, it's more than about being in a deal flow, although obviously that's important if you're going to do direct investing. It's about, yes, deal flow, but it's also a network of, and Kipeng will use the key word, a network of partners and relationships that are complementary to the skills that you have. And that causes us to be, very interested these days, for instance, in combining with other large funds to do joint transactions where we would all take, 15 or 20% of a deal, and we would put the deal together ourselves in a group of large investors, not necessarily just Canadians, but we'd be happy to do it with anybody who's up here today.
We should do one all together.
But
Yes, right.
but working with partners, like-minded funds, that's part of a knowledge network. And then there's another part, which is something that we do a fair bit of work on now too, which is you have all these private equity firms around, and these are very talented people, and they have a lot of expertise. I don't like too much what they charge, and they're also focused. Sometimes they're focused at a level of the market. I mean, they're not very interested in things that come in under 20%. But honestly, we're pretty interested in things that come in. I mean, 15% puts a smile on my face. So does 12, and on a not so good day, maybe 11. So there's a whole structure of the market where there's a lot of things that they would see from a deal flow point of view, but that wouldn't interest them necessarily from an investment point of view. Well, that's a big opportunity for a fund like ours. So we're trying now to build a set of relationships with a selected number of those firms to do things and to design it so that it works commercially, both for them and for us, but that gives us access to a range of activities that are going on in the market that doesn't interest them from a fund point of view, but certainly does interest us. And it's a way of increasing your reach and scope and depth of understanding, because that knowledge network is really, really important if you're going to do direct investing. There's one other comment I'd make about direct investing. I mean, it sounds good if you say it fast, but you really have to know what you don't know. Mm-hmm. And there's a danger. I mean, I find it with our folks, and you want your folks to be all charged up and ready to go, and I can do that, and I can do this, and I'm as good as those guys. And it does require organizationally a capacity to say, that's an interesting investment opportunity, but we don't know enough to do it ourselves. So an example, even though we do a lot of direct investing, a number of years ago, 3-4 years ago, we became pretty interested in building a substantial distressed debt portfolio. And the more we talked about it, the more it became clear that that just wasn't our world, at least not yet. So there's a place where we went outside, because we just had to know what we didn't know. And there are lots of other things. I mean, thanks to the government of China, we hold a substantial allocation of quota to own China A shares. So we invested a lot of Chinese public companies. But we're not competent, honestly, to pick those companies. I mean, that's a stock-picking exercise. So there's another place where we go outside. You just have to know what you don't know and not let your organization drift into places where, frankly, you can get into a lot of trouble.
Well, I think Chris, at Texas, we've been busy establishing these strategic partnerships, which I think gets back to a lot of what you say. You develop strategic partnerships that are totally aligned with you on the public side, strategic partnerships that are aligned with you on your private side, and they have these these alignments. They're set up, they're ready to go. Large commitments to strategic partners that help extend your own internal resources where you're lacking, and also have that expertise that you don't have internally that you need and can continue to do well for you. So it is a big concern of ours as well. So.
I agree with a lot of what you said about direct investing. That happens to be one of the reasons why we haven't done direct investing in private equity very much, because there are 5,000 plus private equity firms out there, really smart, really experienced, really talented people who we look at it and say, could we possibly decipher the value and risk in this deal better than this universe? When we started doing direct deals in natural resources, I think there were maybe 6 investment managers doing natural resources. So the idea that we could, if we had the right expertise, uncover opportunities that the outside managers didn't know better than we did, and that we could build that expertise, seemed like an enticing idea, and it's worked out. But I haven't gotten over the hump of the private, and it gets bigger and bigger, the private equity universe out there, and their ability and experience in picking and choosing, and our ability to compete with that with an internal team.
The only issue, I agree with that. The only thing that we think about it and more about these days is that by and large, those funds, when they look at a deal, it's very much in a 4 or 5 year time frame. Mm-hmm. And they've got requirements to turn over their portfolios, et cetera. So one of the reasons why we are doing more direct investing in private equity than we used to is, again, coming back to what I said about a very long-term time horizon. Sometimes they're not, those firms competent, and they are very competent, are not always there. The alignment of interest between them and us is not always what it needs to be for a very long-term oriented investor like ourselves. One place, well, that's enough.
Although, Michael, I might suggest, though, that in private equity, at least from what we've seen, that 4 to 5 year time horizon, in our view, is if by 5 years you haven't hit double-digit returns, in 10 years you're not going to hit double-digit returns. So while you may think that's a shorter-term time horizon, that's how we look at it. And I think it has played out. You can look at the top quartile private equity managers, and those that are second quartile, and then the bottom quartile. And again, if after 5 years you haven't hit that return, I don't think you're going to get there. So we focus on that a lot, actually.
I'd like to get back to your point about this kind of middle market area, that middle return area, which seems to be a little left out. You got the private equity, above 15, and you got the the fixed income below 8, and there's this kind of middle area that's kind of left void. Anything over 8, right, is interesting to me. You said 11, but yeah, I got to make 8. You know, what's out there that I can make 8? You know, I'm interested in any of those sort of opportunities. So we went on and set up a part of our fund that just catches anything that's, you know, it's not a private equity, it's not a real asset, it's something in between. We set that up in our tactical asset allocation sleeve and said, you know, if you find things like that that are good returners for the fund, meets our actuarial rate obligation, then, you know, let's take a look at it, let's stick it in here, we can figure out where to fund it from what part of the portfolio, using these special opportunities that might come along or in the future. And it's really set up a little bit for the, you know, what's going to happen coming in the Eurozone and what's coming out of the bank loans over there. Probably a lot of that, you know, may fall into this kind of middle range group. So.
We've got about 10 minutes left, and you're leading into me with my final question. I didn't warn you about this, but you can do it on the fly. I think most of the people in the room would be very curious to know, when you think about the forward 6 months or a year, where are you going to put your energy from an asset allocation standpoint? What area is the most interesting to you? And then the question we all tend to get from people, gee, what keeps you up at night? Which I often say is, you know, I usually wake up every couple hours screaming. So let's start, Michael, with you. What area, when you think about, as head of the organization, where are you going to spend your time and effort? What looks interesting?
Well, I got to separate two things here. As I guess, as the head of the organization, you know, every day, my top priority is recruiting the best people we can find. So I'm going to separate here kind of if I can make this false distinction between the leadership role and the investment role. From a leadership role, every day, it's about focusing on where are the best people, how can we get them, where do we recruit, how do we make the place work better, and how do we build a culture that demands high performance and that is at the same time conscious of risk and prudent. So there's a cultural and people development dimension of what I worry about every hour of every day. From an investment point of view, jump to what you said, your last comment, the thing that keeps me up and has me waking up screaming is figuring out, we have every time I say the number, I want to shoot myself. We have a $70 billion fixed income portfolio, and I'm trying to figure out what do we do with that. Yeah. And in the context of pension assets, pension liabilities, whose assets we manage, there are different things you can do there, but that's a big issue and top of mind, number one concern. On the other side, where we're looking for opportunity, I won't go through everything, but I'll just say, I think the United States is a great place to invest right now. In fact, I think the United States is among the most important and the most interesting places to invest in the world. And we do invest pretty much on a global basis. So what we see happening in the United States in energy infrastructure requirements, even in U.S. real estate, even though real estate pricing in the United States is pretty high right now. But in terms of where we're looking for opportunity, the United States is a great place for us. Very quickly, two other things. We're very interested in, if I can call it this, we're very interested in the food chain. There are going to be more people on the planet, and they're going to be eating better quality food. And we're interested in, that goes from farmland to Nestle's.
So the protein trade.
But the whole thing, but the whole span of it. I mean, there are a lot of people interested in agricultural land and other things. We are, but we're interested in the breadth of it, from, in effect, beginning to end. And then finally, I'll shut up. Even though the tide's gone out and people are a little more ambivalent about higher growth or whatever they're called, emerging markets, and I don't like the word emerging, but that interests us quite a bit. And in particular, what interests us in those markets, countries that are going through this transition from kind of export-led growth to consumer-led growth, employment growth, the emergence of upper middle-class consumers, not just mass middle class, but upper middle class consumers, that interests us a lot, and we're looking for opportunities there.
Jane, how about you?
So food and ag is one of our themes. We should look at something together.
Can't go wrong if you work with Harvard.
We like the U.S., but we like emerging markets more, and there are a number of reasons. Emerging markets are trading on a PE basis at a 40% discount to developed markets. That's a pretty significant discount. There have to be opportunities there. And then the confluence of that big overview of valuation disconnect with stock picking opportunities and investment management on site, local, that has gained experience and is getting better and better. So years ago, you might think emerging markets were maybe a little bit cheap, but couldn't find good investment managers, and maybe things moved as a herd. I think we're now at a point where valuations are low, investment management expertise has grown, and we should be able to get great stock picking there, and I'm excited about the opportunities. One other thing that we're looking at, and I think is very interesting, is the biotech and tech in developments that are going on in the US and worldwide right now. And in fact, the pullback in those markets in the last month, I think, is a good thing. I think it had been a little overheated and frothy, but from a fundamental point of view, there are tremendous breakthroughs and strides happening, and those should be really good opportunities for long-term investors.
So the food trade, the innovation trade. Ping, what are you looking at?
Okay. First, as a long-term investor, we think about something like contrarian investment strategy.
Contrarian investments, yeah.
This is very focused on its emerging market.
So are you buying Russia right now? No.
I think Ukraine. In our portfolio have Russia.
Okay.
So this is a key attractive for that is first is long-term growth, potential. So second is valuation very attractive. The key challenge here is selective. So how can you design a new portfolio through external manager or set up ability for your internal whole team selected investment in emerging market? I think that's a challenge, but we explore this strategy. Second is right now we see it's relatively positive or attractive in Europe, Eurozone for distressed, more related to private area. This is the challenge or the key for operation is looking for partner because we don't have ability to do ourselves distressed in Eurozone, but we try to looking for partner work together. This is, we think this is attractive opportunity. Maybe other thing is a selected investment in infrastructure. This is more related to background, investment environment or financial support system arrangement, and also selected real estate, agriculture. So,
great. We've got just 2 minutes left, so sorry to give you the short end, but Cesma and Jerry's.
All right, I'll go fast. I think also what keeps us up at night is our $45 billion fixed income portfolio, of which half of that is invested in core, which if you look at rates staying the same, so we earn 2%, that doesn't really help us. Or if rates start to go up, we lose $2 billion for every point that rates go up. So that's not good either. So we've been spending a lot of time and effort in the opportunistic fixed income area. And we've been focused a lot on Europe as well and distressed. We have some managers out there that we formed strategic mandates with, invested large dollars with, and there's lots of interesting opportunities. I mean, it's been mentioned before in earlier panels early in the week about how the banks in Europe need to unload lots of assets, and so there are lots of interesting opportunities that we see there. Also on the real estate side, real estate distress in Europe has been pretty interesting. We've been doing a lot in direct lending, student loans, those kinds of things to try to increase returns in there. Emerging markets also looks interesting from a valuation perspective. We have a lot of money invested in the US, so we feel good about that, but we really do believe there's now time to look at Europe in those areas and then look at emerging market equities, which have been really beaten up.
Jerry, finish us off.
Sure. So, our stable value portfolio of fixed income instruments, probably most concerning. I think that's evident across the board. The most interesting thing probably going on that keeps us kind of excited too is the energy. Texas is, it's in our backyard, it's under our building, very involved in a lot of things going on in the energy field of upstream, midstream, downstream, and all the effects of cheaper energy and the cost to the economic growth rate here in the U.S. So I think that's the interesting part for us.
So you've heard a whole series of investment ideas, quite a range of spectrum, as I said, $1.5 trillion, which I think all of us are always trying to look to buy low and sell high. It's just a challenge of getting that right. But please join me in thanking the panel for their comments. Thank you.